So, if you look at a traditional commercial bank,
Yeah.
it operates a lot like a commuter train, running on a fixed track.
Right.
It's incredibly safe, heavily regulated, and just highly predictable. You board the train, it goes 30 miles an hour, and it gets you to your 4% yield right on schedule.
The tracks are laid out years in advance, right? The risk models are rigid, and the collateral is completely standardized. It's a system that's built entirely around just, avoiding surprise.
Avoiding surprise.
Yeah.
But when you step into the world of specialized business development companies, or BDCs, you are stepping off that commuter train and you're getting onto an all-terrain vehicle.
Oh, yeah.
The tracks just disappear. You're suddenly navigating these rocky, unregulated paths, especially when those BDCs operate in, transitioning industries. The ride is bumpier. The steering requires a lot more active management, but the potential yields are significantly higher.
Much higher, yeah.
And right now, Advanced Flower Capital, ticker symbol AFCG, it looks like an ATV that the broader market just believes has 4 flat tires and a blown engine.
Right. That's the perception anyway.
Yeah, that's the perception. Because on paper, they have incredible cash flow, but the stock is trading like it's an absolute distress sale.
So today, for this Talk Tickers deep dive, we are looking at their Q2 2026 earnings to figure out, why there's such a massive disconnect between their actual financial engine and their share price.
Yeah, and it's a huge disconnect.
Right. So our mission here, we have the Q2 2026 earnings call transcript from AFCG, and we're going to extract the most critical data, translate the Wall Street jargon, and deliver an opinionated, actionable summary for retail investors in under 5 minutes. Though, to be fair, getting to that 5-minute summary is going to take us a little bit of time today to unpack.
Oh, yeah, there's a lot of weeds to chop through first.
Exactly. Okay, let's unpack this. Because the core metrics they reported, they paint a really fascinating picture of a company quietly executing a massive turnaround. Yeah, a turnaround that is hidden inside this often kind of stuffy BDC sector.
Right.
The raw data from this quarter is genuinely compelling, especially when you consider the broader macroeconomic environment we're in right now.
Absolutely.
If we look at their net investment income, or NII, they reported $3.5 million for the quarter.
Okay.
And on a per share basis, that translates to 15 cents per weighted average share.
Wait, let's hold on that net investment income number for a second.
Yeah.
Because for anyone used to looking at just, standard corporate earnings, NII requires a slight mental shift.
Right. It's not standard EPS.
Exactly.
Yeah.
A regular tech or manufacturing company reports earnings per share, and they can do literally whatever they want with that money, right? Yeah. They can hoard it, build a new factory, buy another company.
Sure.
But a business development company is structurally different. By law, to maintain their tax advantage status, they have to distribute at least 90% of their taxable income back to their shareholders.
Yep, the 90% rule.
Right. So net investment income isn't just some abstract accounting metric. It's the literal cash engine that determines how big of a check the investors are going to get in the mail.
Exactly, which is why that 15 cents per share is such a critical baseline. It tells us exactly how much recurring cash the portfolio actually generated. And alongside that, we saw their net asset value, their NAV. It jumped from $7.90 in the first quarter to $8.25 in the second quarter.
Okay, an increase of 35 cents per share in a single quarter is huge.
It is.
Especially when you consider that they're operating a debt portfolio, right? They're not a high-growth software platform that just scales infinitely.
Right, debt is usually pretty steady.
Yeah, but I have to push back here for a second, because if I'm a retail investor and I'm running a quick stock screen on AFCG, I'm going to see a glaring red flag on the top line.
Okay, lay it on me.
Their total investment income for Q2 came in at $8.7 million. But if you look at the previous quarter, Q1, that same top line revenue number was $9.8 million.
Yep.
So they dropped over $1 million in revenue quarter over quarter. I mean, as an investor, if I see revenue shrinking by over 10% in 3 months, I'm assuming the core business is bleeding out.
Yeah. And look, it's a totally rational fear if you're just glancing at a Yahoo Finance page or a financial aggregator site.
Right. Just look into the headline numbers.
Exactly. But the context provided by their chief financial officer on the call, Brandon Hetzel, it entirely reframes that drop.
Okay.
that decline from 9.8 million to 8.7 million has absolutely nothing to do with a shrink in core business.
Really?
Yeah, it's a structural artifact of how private credit operates.
Okay, so what actually happened in Q1 to artificially inflate that number?
Well, in the first quarter, AFCG recognized $1.8 million in non-recurring exit fees.
Ah.
Yeah, the bulk of that, about 1.5 million, came from a single borrower named Bloom, who basically repaid their loan early.
Okay, I see.
And in the institutional lending space, if a borrower wants to exit a credit facility before the maturity date, maybe they found a cheaper bank or they got acquired, they can't just pay back the principal and walk away.
Right, because the lender was counting on that interest.
Exactly. The lender built an expected yield model based on the life of that loan. So they charge a hefty prepayment penalty or an exit fee to compensate for that sudden loss of future interest.
Oh, okay, that makes total sense. It's like breaking a commercial lease.
Yeah.
You have to pay a massive penalty to get out early. So that $1.8 million windfall in Q1 made their top line look incredible, but it was just episodic. It was a one-time cash grab.
Right, exactly. And if we strip away that 1.8 million windfall from the 9.8 million Q1 total, their true baseline interest income for that period was 8.0 million.
Yeah.
So compare that 8 million baseline to this quarter's 8.7 million, and you realize their underlying recurring income didn't shrink at all. It actually grew by almost 9%.
Oh, wow.
Yeah, the engine is accelerating.
Okay, and that acceleration ties directly into what is arguably the most important metric for anyone holding a BDC, which is the dividend coverage.
Oh yeah, absolute king.
Right. We established that their cash engine, the net investment income, produced 15 cents per share this quarter.
Mm-hmm.
But AFCG only declared a quarterly dividend of 5 cents per share.
Which leaves them with a 3x coverage ratio.
Right.
They are pulling in 3 times the amount of cash required to fund their distribution.
And I just want to emphasize for the listeners, in the BDC sector, a 3x coverage ratio is a unicorn.
It really is.
Most of these companies, they're paying out 90% or even 100% of their earnings just to maintain a high yield and keep retail investors happy.
Yeah, they have to keep the yield chasers fed.
Exactly.
Yeah.
So they're walking a tightrope. If 1 or 2 loans go bad, they have to slash the dividend, and then the stock price just collapses.
Oh, it craters.
Yeah. But AFCG is sitting on a fortress of a safety cushion. For every nickel they hand to an investor, they have a dime left over to reinvest or build cash reserves or buy back stock.
And that excess coverage, it entirely dictates their corporate posture. They are not playing defense right now.
Right.
They aren't stressed about a mild economic downturn, forcing a dividend cut. They have total flexibility.
Okay, so we have a growing underlying cash engine.
Right.
An expanding net asset value of $8.25 and a hiker secure dividend.
Yep.
Which brings us to the central mystery of this company. If the financial mechanics are this strong, why is the stock market pricing this company at such a steep discount to that $8.25 NAV?
Good question.
I mean, why are they being treated like a toxic asset?
Well, because public markets absolutely despise uncertainty.
It's true.
They hate messy transitions, they hate litigation, and above all, they are incredibly impatient.
Right.
And AFCG is currently slogging through a very messy, very public transition regarding their legacy portfolio.
It's like they're dealing with a group of messy roommates.
Yeah, that's a good way to look at it.
Like, imagine you own a luxury apartment building, right? The property is fundamentally valuable.
Sure.
But in a few of your units, you have these tenants who stopped paying rent 6 months ago. They're damaging the property, and they absolutely refuse to leave.
The worst kind of tenants.
Right. You know that if you can just get them evicted, clean up the units, and bring in, doctors or lawyers, the building will be a cash cow.
Yeah.
But the actual legal process of eviction is ugly. You've got court dates, sheriff's deputies, angry shouting matches in the hallway.
It's a bad look.
It's a terrible look. Yeah. Anyone walking past the building just sees chaos and assumes the whole property is a dump.
And that dynamic captures exactly what is happening with AFCG's legacy loans in the cannabis sector.
Right.
These are loans that have been placed on non-accrual status.
Okay, let's break down the mechanics of a non-accrual loan for a second, because that's a term that gets thrown around a lot.
Yeah, it's important.
When a borrower falls significantly behind on their payments, the lender can't just keep pretending everything is fine. Accounting rules require them to place the loan on non-accrual, which means they literally stop recording the expected interest as income on their income statement.
Right.
It's the financial equivalent of acknowledging that the tenant is a deadbeat and just zeroing out the expected rent.
Exactly. And it becomes a massive anchor on the portfolio's yield. The capital is trapped in a non-performing asset, generating absolutely nothing, while the lender incurs legal fees trying to recover the principal.
Which is brutal.
It is. And AFCG's president and chief investment officer, Robin Tannenbaum, she spent a significant portion of the call addressing why this happened.
Okay.
The core issue isn't necessarily that cannabis operators don't have good underlying businesses.
Right.
It's a structural crisis in how the industry is capitalized.
Yeah, she pointed out that despite the positive political headlines, right?
Yeah.
Like the ongoing discussions around rescheduling medical cannabis at the federal level.
Right, Schedule 3.
Yeah, exactly. Despite all that, the industry is suffering from a devastating drought of equity capital. And a debt provider like AFCG feels the pain of that equity drought acutely.
Absolutely, because a healthy capital structure requires a balance of debt and equity.
Right.
Debt eventually matures. When a 5-year loan comes due, the borrower rarely has the sheer cash on hand to just pay off the entire principal.
Yeah, they usually refinance it.
Exactly. But to convince a new lender to refinance that debt, the company needs to show a strong balance sheet, which usually requires raising fresh equity capital.
But because cannabis remains federally illegal, institutional investors, massive pension funds and major endowments, they generally won't touch cannabis equity.
I can't really.
Right. Their compliance departments won't let them. So these operators can't raise cash. When their debt matures, they just hit a brick wall. Tannenbaum called it a loss of refiability.
Yeah, refiability.
The companies are suffocating under debt they cannot roll over, regardless of how many pre-rolls they're selling at the actual dispensary.
And that structural suffocation is exactly what led to AFCG having to initiate these evictions.
Right.
But the earnings call provided very granular updates on the progress of cleaning up these specific non-accrual loans.
Yeah, they really didn't hide from it.
No, they didn't. The first major update was regarding a borrower named Devi.
Oh, yeah, the Devi situation. That one feels like the messy roommate is finally packing the moving truck.
Yeah, exactly.
The court-appointed receiver who took over the assets has been actively liquidating them. During Q2, they actually signed a binding term sheet to sell 2 of Devi's remaining assets for $12.5 million in cash.
Right. And importantly, CEO Daniel Neville noted that after the quarter closed, they secured a $2 million non-refundable hard cash deposit on that $12.5 million deal.
Okay, that's huge.
It is. It takes it out of the realm of, hopes and dreams and makes it a highly probable liquidity event.
Yeah, a hard deposit changes everything.
Exactly. And AFCG holds roughly an 80% participation in that specific loan facility. So when that deal closes later this year, a massive chunk of dead capital is going to convert straight back into usable cash on their balance sheet.
And we saw the exact same mechanical process playing out with another borrower, DMA.
Right.
The receiver in that case successfully closed the sale of 2 dispensaries in July, right after getting the required regulatory approvals in June.
Yep.
So they're methodically turning these distressed cannabis assets back into cash. But not all of these evictions are going smoothly.
No, they are not.
Then you have Justice Grown.
Ah, Justice Grown. That's the roommate who barricaded the door and is daring you to kick it down.
Right.
Their loan officially matured on May 1st, 2026, and they just failed to pay the principal. They are in a hard maturity default.
And AFCG is not negotiating anymore.
No.
Neville stated on the call that they have commenced Article 9 foreclosures.
Right.
And for anyone not steeped in commercial credit law, an Article 9 foreclosure is a mechanism under the Uniform Commercial Code.
It allows a secured lender to legally step in, seize the physical collateral that backed the loan, and sell it off to recover their money. They don't have to wait through years of bankruptcy court proceedings, if the loan is structured correctly.
Which is key. And AFCG's collateral package on the Justice Grown loan is substantial.
Yeah, it's a lot.
It includes vertically integrated operations in New Jersey, 3 active dispensaries in Pennsylvania, and a cultivation facility.
Wow.
And they've already brought in a firm called SSG Advisors to market and sell these assets.
But Neville was very blunt on the call. I mean, he refused to provide deeper commentary on Justice Grown because they're in the middle of active litigation.
Right, he can't say much.
Yeah, they're pursuing parent company guarantees, shareholder guarantees, everything. And if you're a retail investor seeing Article 9 foreclosures and active litigation dominating a company's headlines, It's terrifying.
Oh, yeah. It sounds awful.
It sounds like the business is just falling apart, which totally explains the massive discount on the stock price. The headlines are definitely ugly. But we have to look past the immediate legal drama and understand the underlying strategy here.
Right.
Why is management willing to endure the brain damage of foreclosing on dispensaries and fighting in court?
Why go through the hassle?
Exactly. It's because they are funding a hard pivot. As they extract cash from these equity-starved cannabis operators, they are not writing new loans in the cannabis space.
Right.
They are entirely transitioning their capital into much healthier traditional markets.
They are evicting the bad tenant and renting the apartment to a reliable doctor. Literally, yes. The prime example of this pivot from Q2 was a brand new $7 million commitment they made to an outpatient behavioral health platform located in the Northeast.
Right. They funded the first $3 million of that commitment in July. And if you look at the characteristics of that borrower, it is the exact antithesis of a cannabis startup.
How so?
Well, Neville described a business with 10 established locations providing talk therapy and medication management.
Which is highly predictable.
Very.
I mean, people don't stop going to therapy or taking their medication just because the stock market has a bad week.
Exactly.
It's highly recession-resistant, it generates consistent cash flow, and it obviously doesn't face the existential threat of federal illegality.
Right.
It's a boring, reliable business, which is exactly what a debt provider wants.
Boring is beautiful in credit. And this transition into traditional lower middle market lending, it's happening at a really fascinating moment in the broader macroeconomic cycle.
Okay, here's where it gets really interesting for me.
Yeah.
Because if you zoom out and look at the whole private credit landscape, the narrative is actually quite grim right now.
It is.
On the call, Tannenbaum referenced a report from Fitch that showed the default rate in private credit hitting 6% as of July 2026.
That's high.
Yeah, and the Proskauer Private Credit Default Index is showing the exact same stress. Borrowers across the country are struggling with higher interest rates, and traditional lenders are taking on water.
Normally, a spiking default rate in the credit markets would be a massive red flag for a company like AFCG.
Right, you'd think they'd want to run away.
Exactly. But what's fascinating here is the structural inefficiency it creates.
Okay.
AFCG's management doesn't view this macro stress as a threat. They are actively exploiting it as like a once-in-a-decade opportunity.
Okay, but how does a broader credit crisis actually benefit a lender who's just trying to pivot into that space?
Because it alters the supply and demand curve for capital.
Okay.
Because defaults are rising, legacy lenders, your regional banks and the massive heavily regulated direct lending funds, they're aggressively pulling back.
Right.
Regulators are scrutinizing bank balance sheets much closer after the turmoil we saw in the banking sector over the last few years.
Yeah, post-SVB and all that.
Exactly. So these traditional institutions are retreating. They're either hoarding cash to shore up their own reserves, or they're abandoning the lower middle market entirely to focus exclusively on massive, multi-billion-dollar companies where they feel safer.
So the local behavioral health clinic, or the regional manufacturing plant, suddenly finds that their local commercial bank just isn't returning their calls.
Yep.
The supply of available loans is drying up, but the businesses still need capital to grow, to acquire competitors, or manage their working capital.
Exactly. The demand for capital is constant, but the supply is artificially constrained by regulatory fear.
Right.
And Tannenbaum drew a really sharp contrast on the call. She noted that in the upper middle market, loans of hundreds of millions of dollars, there's still a massive glut of institutional money.
Because everyone retreated up there.
Right. Mega funds are competing fiercely for those deals. They're undercutting each other on interest rates and accepting what are known as covenant-like structures.
Okay, we have to talk about covenant-like structures because that is wild. A covenant-like structure is basically a lender giving up their legal safety nets just to win the business.
Pretty much.
A standard loan has maintenance covenants, right? These are financial fitness tests the borrower has to pass every single quarter, like keeping their debt-to-income ratio below a certain level.
Right.
And if they fail the test, the lender can immediately step in, demand repayment, or take control before the company actually goes bankrupt.
It's an early warning system.
Exactly. But a covenant-light loan strips those tests away.
Yeah.
The lender is essentially blindfolded until the borrower literally runs out of cash and defaults.
Right. And while the mega funds are giving up their protections to win deals at the top of the market, AFCG is pivoting into the lower middle market where competition is scarce.
Wow.
Because there are fewer lenders willing to write a $15 million or $20 million check right now, AFCG holds all the leverage at the negotiating table.
They don't have to accept covenant-like garbage.
Exactly. They are dictating incredibly stringent terms. They're getting higher interest rates. They're securing the loans against hard physical assets, and they're demanding rigorous quarterly maintenance covenants.
They get to play the role of the strict parent because they're the only ones handing out allowances right now.
That's a great way to put it.
But that brings us to a massive logistical question.
Okay.
If the traditional banks are pulling back because money is tight, and AFCG is currently bogged down in these expensive foreclosures, how exactly are they funding this aggressive pivot? I mean, you can't write a $7 million check to a behavioral health clinic with a foreclosed dispensary. You need actual cash.
You do. And to understand how they are pulling this off, we have to look really closely at their balance sheet. And the data Hetzel provided is staggering.
Okay, let's hear it.
They ended the second quarter with $106.5 million in cash and cash equivalents.
Wait, $106.5 million in pure unencumbered cash sitting in the bank?
Yep.
For a company with a market capitalization that is hovering around, what, 150 million?
Around there, yeah.
Having over 100 million in cash is almost absurd.
It is. And that's just the cash on hand. Yeah. Hetzel also noted they have over $70 million in additional available liquidity ready to draw upon.
Okay.
To understand the true scale of their financial firepower, we have to look at their debt structure. They currently have $207 million in total outstanding debt, which is split across a secured revolving credit facility, an unsecured facility, and some senior unsecured notes.
Which brings us to the leverage ratio.
Yes.
Their net debt to equity ratio is currently sitting at 0.53x.
Right.
Let's translate what that actually means for their operational capacity, because this is where the engine really revs.
Yeah, because leverage is the fundamental engine of a BDC.
Right.
The entire business model is based on arbitrage. A BDC borrows money from larger institutions at a relatively low rate, say 6%.
Okay.
And then they lend that money out to middle market businesses at a much higher rate, like 13%.
Right.
They capture the spread in the middle. The regulatory framework governed by the SEC allows BDCs to operate with a maximum debt-to-equity ratio of 2.0x.
Meaning they can legally hold $2 of debt for every $1 of equity.
Exactly.
And most established, fully deployed BDCs, they operate comfortably around 1.2x or 1.3x leverage.
Right, they use it.
They're utilizing that borrowed money to maximize the returns for their shareholders.
Sure.
But AFCG is sitting all the way down at 0.53x. They essentially have 53 cents of debt for every dollar of equity. They are remarkably under-leveraged compared to their peers.
Very much so. And during the Q&A portion of the earnings call, an analyst named Pablo Zuanic, he honed in on this exact point.
Okay.
He asked management where they actually want that leverage ratio to be long-term. And CEO Daniel Neville, he didn't hesitate. He stated that they are entirely comfortable taking that leverage up to 1.0x and potentially even higher as an intermediate target.
So if you're currently at 0.53x and your target is 1.0x, the math is incredibly straightforward. You have a massive untapped reservoir of borrowing capacity. They don't have to go out and issue new shares, which would dilute the current investors, just to raise capital for this pivot.
No dilution necessary.
Right. They can literally just tap their existing credit lines and deploy their massive cash pile to fund these new loans.
They have a mountain of dry powder ready to deploy, and they are actively looking to deploy it.
Good.
Neville noted that their active pipeline of potential new loans currently sits at $1.3 billion.
Wow.
Yeah, and they're specifically targeting established companies generating between $5 million and $50 million in EBITDA.
Which is basically their raw operating profit.
Exactly.
And that 5 to 50 million EBITDA range is the absolute sweet spot of the lower middle market.
It really is.
I mean, these are not speculative tech startups burning cash, and they aren't Fortune 500 companies that can just issue public bonds on Wall Street.
Right.
They are solid regional companies that rely heavily on private credit to function.
However, during the Q&A, another analyst, Aaron Thomas Gray, brought up a very practical concern.
What did he ask?
Well, he pointed out that despite this massive $1.3 billion pipeline, AFCG only actually funded about $17 million in new loans during the second quarter.
Oh.
He essentially asked, if you have so much money and so many leads, why did originations slow down compared to earlier in the year?
Okay, that is the exact question a skeptical investor should ask. Are they struggling to actually win these deals?
Right.
What did Neville say?
His answer provided a really great look into the reality of institutional lending. He explained that originations in this specific tranche of the market are inherently lumpy and episodic.
Lumpy and episodic.
Yeah. You don't just evenly fund $30 million every single month like clockwork.
Right, because they aren't algorithmically approving credit cards. They're negotiating highly complex, customized, senior secured, first lien debt investments. It takes months of due diligence, legal structuring, and negotiation. You might have 3 deals close in Q1, resulting in $80 million deployed, and then only 1 deal crosses the finish line in Q2.
Right. And you mentioned first lien debt, and we really need to unpack that because it is the bedrock of their risk management strategy.
Absolutely.
First lien debt means that if the borrower completely fails, goes bankrupt, and the assets have to be liquidated, AFCG holds the absolute highest priority claim on the proceeds.
Right.
They are legally first in line to get paid back before the mezzanine debt holders, before the equity investors, before anyone else.
If the ship goes down, AFCG owns the lifeboats.
That's exactly it. And their entire income-producing portfolio is structured this way. 100% of their $289.8 million investment portfolio is senior secured first lien debt. They are not taking high-risk equity positions. And yet, despite being in the safest position in the capital stack, they are still generating massive returns. The weighted average yield on their debt investments is currently 13.2%.
Okay, so let's connect the dots on the leverage model we discussed earlier.
Let's do it.
Hetzel noted their weighted average cost of borrowing is about 6.3%.
Okay.
They're borrowing at 6.3% and lending it out at 13.2% with first lien protections.
Yep.
That is a nearly 7% spread on every dollar they deploy. And they have the balance sheet capacity to scale that up aggressively.
Furthermore, they possess a unique structural advantage that Neville highlighted, which allows them to compete for higher tier loans.
Oh yeah, the relief order.
Yeah, they operate under a specific SEC co-investment relief order.
This is a nuance that usually gets buried in the footnotes, but it is so vital.
It really is.
The Investment Company Act of 1940 places strict limitations on how affiliated funds can invest together, primarily to prevent self-dealing and conflicts of interest.
Right.
Without an exemption, a BDC generally cannot just pool its money with other private funds managed by the same parent company to fund a single massive loan.
But AFCG went through the grueling regulatory process to secure that exemption. This relief order legally allows them to partner alongside their broader management platform's other affiliated funds. So when that $7 million behavioral health facility deal came across their desk in July, AFCG didn't have to swallow the entire massive loan facility themselves, which might have ruined their diversification limits.
Right.
They took their $7 million piece, and their affiliates funded the rest.
Oh, that's huge. It effectively allows AFCG to punch drastically above its weight class.
Exactly.
They can secure top-tier $30 million or $40 million institutional deals, demand the strict covenants that come with that scale, but only hold a comfortable $7 million slice on their own balance sheet.
Yeah. It's a massive competitive moat against smaller lenders who don't have an affiliate network.
So if you synthesize all of these elements, right, the 106 million cash pile, the massive untapped leverage capacity, the retreat of traditional banking competition, the strict maintenance covenants, and the co-investment relief order.
Yeah.
You are looking at a management team that is uniquely equipped to flawlessly execute this pivot out of cannabis and into mainstream commercial credit.
Which brings us to the ultimate question for our listeners.
Here we go.
We have waded through the murky waters of non-accrual accounting, we've broken down the leverage mechanics, and we've analyzed the macro tailwinds.
We covered a lot.
So what is the verdict? I mean, are we looking at a value trap or a genuine opportunity? Are we bullish or bearish on advanced flower capital?
Look, Based purely on the mathematical realities detailed in this earnings call,
Yeah.
I have to take a cautiously bullish stance.
Cautiously bullish. Okay. Yeah. And the foundation of that optimism isn't just about their future loans. It's rooted entirely in how management is currently utilizing their share repurchase program.
Yes, this is where the true, undeniable value creation is just hiding in plain sight.
It really is.
Let's break down the mechanics of this buyback, because it is the ultimate proof of concept for the turnaround.
If we connect this to the bigger picture we discussed earlier, the stock market is currently pricing AFCG shares at a massive discount.
Right.
Retail algorithms and institutional screeners see the headlines about cannabis foreclosures, they see the revenue drop from the missing exit fees, and they run away. The stock price tanks.
The market is panicking over the loud eviction happening in the hallway, completely ignoring the fact that the building itself is fundamentally pristine.
But management isn't relying on public sentiment. They have the audited financials. They know that the Devi asset sales are locked in with hard deposits. They know the dispensaries in Pennsylvania are being liquidated. They know with mathematical certainty that their net asset value is $8.25 per share.
So, when the public market panicked and priced the stock significantly lower, what did management do?
They pounced.
Yeah, they did. During the second quarter, they aggressively activated their share repurchase program, buying back roughly 839,000 of their own shares.
And the execution price is the key here.
Oh, this is the best part.
They bought back those 839,000 shares at a weighted average price of $3.29 per share.
Let me stop you right there, because this is the absolute holy grail of value investing.
Yeah.
Their internal accounting, verified by external auditors, states unequivocally that the company's underlying cash and loans are worth $8.25 for every single share in existence.
Right.
But the stock market was so disinterested, or so easily spooked by the cannabis headlines, that it was willing to sell those exact same shares back to management for $3.29.
It is the definition of arbitrage. When your NAV is $8.25 and you are buying your stock back on the open market for $3.29, you are quite literally buying a dollar bill for 40 cents.
And what happens mechanically when a company buys those shares and retires them? It triggers a process called accretion.
Exactly. Imagine a pizza that is cut into 10 slices.
Okay.
If the company buys back 2 slices and destroys them, the total size of the pizza hasn't changed, but now it is only divided into 8 slices.
Right.
Every remaining slice is suddenly much larger. Because AFCG bought those 839,000 shares at a 60% discount to their true value, the underlying assets of the company are now divided among fewer outstanding shares.
And what was the actual impact?
Hetzel explicitly stated on the call that this specific repurchase activity immediately added 17 cents per share to their net asset value in just 1 quarter.
Without making a single new loan.
Right.
Without taking on any additional credit risk, they literally engineered 17 cents of guaranteed value for every investor who simply held on to the stock.
Yep.
It is a mathematically guaranteed return on investment. And the best part, they still have $2.2 million authorized in that share repurchase program to continue doing it, as long as the market keeps mispricing the stock.
And I cannot stress enough how rare this behavior is in the BDC sector.
Why is that?
Well, the compensation structure for most BDC management teams is directly tied to their total assets under management, or AUM.
Okay.
They get paid a management fee based on the sheer size of the portfolio.
Right.
Because of that, most management teams are obsessed with empire building. They want the company to be as large as possible, so they absolutely loathe share repurchases.
Because using cash to buy back stock shrinks their total asset base.
Exactly, which directly shrinks their own paychecks.
Right. They would rather issue new dilutive shares at a massive discount just to raise more cash and grow the AUM, even if it destroys the per share value for the retail investor.
Precisely. The fact that AFCG management is actively utilizing their cash to shrink their asset base and buy back heavily discounted stock, it's the ultimate signal.
Yeah.
It proves they are completely aligned with maximizing shareholder value on a per-share basis, rather than just enriching themselves through AUM fees.
So what does this all mean? Let's distill all of this complexity into an actionable summary for the average investor looking at this stock today.
Yeah, let's bring it home.
If you are researching AFCG, Your decision ultimately comes down to your personal tolerance for headline noise. If you're the type of investor who cannot stomach near-term legal drama, if reading quarterly updates about Article 9 foreclosures and maturity defaults in the legacy cannabis sector is going to make you nervous and cause you to panic sell, then you should just stay away.
Yeah, it's not for the faint of heart.
Right. The messy roommates are going to continue making a lot of noise, generating ugly legal headlines and causing volatility on their way out the door.
Definitely.
But if you can look past the superficial noise of those evictions and focus entirely on the underlying mathematical mechanics, you're looking at an incredibly compelling setup.
Very much so.
You have the opportunity to buy into a heavily discounted net asset value. You are securing a hyper-safe dividend that is covered 3 times over by recurring cash income.
Yeah.
You are backing a fortress balance sheet equipped with $106.5 million in pure cash and a massively under-leveraged debt profile.
Huge advantage.
And most importantly, you are partnering with a management team that is actively exploiting market inefficiencies, both by negotiating ironclad loans with maintenance covenants in a starved credit market and by utilizing a buyback program to instantly create accretion for you.
Right.
They are methodically transitioning this portfolio away from structural risk and into recession-resistant industries where they hold all the pricing power.
It is a masterclass in a textbook turnaround play, financed by a pristine balance sheet and executing in a macroeconomic environment where their traditional banking competitors are just terrified to compete.
It really is. They are taking that chaotic ATV ride through the messy cannabis transition, and they're using the cash to buy a ticket right back onto the safe, predictable commuter train of traditional middle market credit, all while locking in massive spreads.
And that transition raises a much larger structural question, one that extends far beyond just AFCG.
Okay, what is it?
It's something our listeners should really mull over as they analyze the broader financial sector.
All right.
We are currently watching an unprecedented retreat by traditional banks.
We are.
Bogged down by regulatory scrutiny, increased capital requirements, and a fear of macroeconomic stress, regional banks are abandoning the lower middle market.
Right.
If this structural shift becomes permanent, our nimble, heavily capitalized, and under-leveraged BDCs going to permanently replace commercial banks as the primary engine for American middle market business growth.
Oh, wow.
Because if specialized private credit is the new normal for these businesses, the 13% yields and strict covenants that companies like AFCG are locking in today aren't just a temporary anomaly.
Right.
They are going to look like historic foundational assets a few years from now.
That is a brilliant thought to leave on. I mean, if the local banks are too scared to fund the behavioral health clinics and the regional manufacturers, the BDCs are holding all the cards and they are dictating the rules of the game.
They really are.
Thank you for joining us for this deep dive into the mechanics of the market. We'll get you on the next one.